Well, good morning, folks. If you guys could give me a heads up on X, let me know you guys can hear me. Audio seems okay on my end. Thank you, Alfonso. Thank you, friend. Thank you, Edward. All right, so this morning we have some medium and high impact news drivers. And I want to kind of like go over that with you live because I can't be with you this afternoon and I can't be here during the opening bell during the morning session. So I have some things I have to take care of that I was not able to get accomplished last night. So that's the real life getting in the way. It's going to happen. So as a consolation, we're going to be looking at the core retail sales number, retail sales, unemployment claims, and the medium impact Philly Fed manufacturing index. That's all going to be released this morning at 8:30. So today is Thursday, October 17th. That's on the docket for today. And then for you guys that like to trade crude oil, at 11 o'clock today, you'll have the crude oil inventory number. I think that's going to be enough. I'm going to close the stream promptly at 9 o'clock or before if it serves my purpose. But I just want to sit here and tape read with you. In about 15 minutes or so, when that news hits the market, we'll see what they want to stir up in terms of runs on liquidity or inefficiency. Tomorrow morning at 8:30, we have building permits, and then we have a speaker later on in the afternoon around lunchtime. So not terribly exciting. Forex guys, you'll have some real nice volatility on the pound tonight going into Friday morning session, London 2 a.m. Eastern time. You have retail sales for GBP. All right, so let's get on with this. Take a look at what we have in terms of liquidity pools and all that stuff. Give me a second. Sorry about that. I had to put you on mute for a second. Scout had a barking fit, and that would have been just uncivilized for today. All right, so we are looking at the NASDAQ, and let's start with the daily chart real quick. All right, so here's the business. We can ignore all this stuff here. This is stuff from yesterday. We do have a really nice Sell side still building underneath that. Buy side is here. We have Tuesday's October 15th daily high. I want to annotate that rather as well. And we'll just note that as Tuesday's high. All right. And we'll drop down into a 60-minute chart. And right away, you should see this is this begging for it. So in my mind, it's a little too clean. I like the idea of a potential run up into that. It doesn't need to do it today. It may need to do it, overnight tonight. It may need to do it tomorrow. I think that it's reasonable to anticipate them taking it up there to those 640s at the minimum, and then Tuesday's high 659 and a quarter, and then 680 respectively, which would be this high there. So I'm looking at how we made this area down here, which was below these relative equal lows. They made that jagged. We're trading up into the SIBI here, the sell side imbalance, buy side inefficiency. And to me, while being in an election year, as I've been basically beating that drum constantly since we started the 2024 mentorship, it's very difficult to try to short this market and hold for a long time. Not that you can't take shorts on intraday, but it's very difficult to hold on to shorts because they keep sending it higher, and it's all artificial. It's all fluffing up, and it's usually it's a presidential year phenomenon. So don't think it's just happening just this year. It's a usual circumstance that tends to repeat itself. So focusing on the buy side is always going to be my first go-to. So I'm going to be looking for things to justify something that would lend well to a draw up into this area here. So these two respective highs, that's where my initial interest is. Now, obviously, we don't know what they're going to do when the high impact news drivers come out. When these news events come out at 8:30, they're used as a smokescreen, and sometimes they can aid a run into an area or a layer of liquidity like we're outlining here, or as I'm outlining it rather. And then other times it'll be used to drop it down and get everyone thinking that the sentiment is bearish. And then at the opening bell later at 9:30, then they make a run for it to get up here. Either scenario, I'm just interested in what they're doing at 8:30. And then I will leave you with closing remarks about how I would expect to see the opening bell and the morning session pan out. In other words, what would be my interests? Okay, so kind of like I don't leave you like an orphan, figure it out on your own. Even though I can't be here, I'll kind of like tip my hand and tell you, if I were here with you, this is what I would look for. Okay, so it kind of like gives you some study notes, if you will, points of reference to try to tape read and figure out what you see real time when it occurs. We'll drop down to a 15-minute time frame. All right, and then yeah, I still like the idea of it wanting to get up here because it's two reference points here. We have this high to that high, this high being lower than that one, and then this high and that high being lower than that one. So we have two nested relative equal highs. It's just real obvious. And whenever it's like that, it's easy to just side with that as the initial draw until price proves it's not interested in that. And you would know that obviously by what we see at 8:30 when they release the data. That all those numbers that come out in those reports, they're already baked in. Okay, trust me, it's always the case. And trying to figure out what that fundamentally means for the intraday price volatility is useless. Okay, so it's better just to anticipate the fact that we have a high impact and medium impact news events, reports, data coming out. We are never interested in what the data is suggesting. That makes it easy because fundamentally speaking, you're never going to be able to read the tea leaves like that on an intraday basis and be accurate. because there's many times that the data will be suggesting it should be bullish or bearish, and the market does the opposite. And I learned very quickly in the 90s that that wasn't the way of doing it. So I just trust that the price is going to tell me everything I need to know. And if I'm wrong, price will tell me I'm wrong. I don't need to try to figure it out and put my opinion on what fundamental data is suggesting. So again, just we're focusing up here, okay? Or at least that's where my focus is. And then we'll go down to a 5-minute chart. Okay, and I have enough time I can show you what I was doing this morning in London. I had a little bit of a late nap yesterday. And as you all probably know, I've said it many times, that I don't have a normal sleep schedule because I don't work a job. I don't get stressed out and get tired like the average person does, and like I did when I was younger. I sleep in 2 stages of like 4 hours each time. Doesn't always equate to 4 hours. Sometimes it may be 4.5 hours, but the afternoon yesterday, I kind of like took my second one a little later than I normally do, and it kind of threw my pattern off a little bit more. So I woke up at a time during London that's like, well, I don't feel like getting out of bed, so I'll just look at the market and see if I can play around with that. And lo and behold. All right, so we have the market break above the short-term high here after having a run on liquidity below this low in here, trading back down once more into a delivery to this volume imbalance. Rallies up. That means the breakout arcs are going to be long above this high. I like seeing that in the London session. I love seeing false breaks where a breakout trader would get in long or short. Because the market's predisposed to go higher because it's an election year. This high, they would have went long, they ran down, stopped them out. That's a beautiful setup, because now what did they do? They took the market higher, putting traders in long, ripping their guts out, removing their head cleanly from their shoulders. And then what I'm going to wait for is I want to see, does the market give me an opportunity to get in when the price is dropping and it's going into an obvious discount array. We have this imbalance here. After clearing this high, all of this consolidation here, this is kind of like resembling much like a first stage accumulation. So looking at it like that, we trade down into the fair value gap, always including the volume imbalance. Sometimes when I'm doing the live streams, folks, I know some of you are leaving comments saying sometimes I won't include the volume imbalance. I'm 52 years old, and I'm not trying to use that as an excuse, but my eyes are not as good as they used to be. And because I'm looking at very, very short-term time frame charts, I'm more keyed up on the price axis over here than the candlesticks. So when I'm drawing the boxes on the charts that draw your attention to it, sometimes it doesn't drop onto the actual candlestick like it does here perfectly, and does here perfectly, because I'm trying to annotate it and then still keep my train of thought. It may not fall on the volume imbalance, and it's not me doing it incorrectly for the purpose of being troublesome for you. It's just I'm trying to juggle all these things real time and still be able to talk about and also read it real time. So it's not easy to do this, okay? And it's sometimes I won't have that box highlighting with the volume imbalance, but you should always have it annotated like that, okay? So anyway, the market drops down into the fair value gap here, which is a buy side imbalance, sell side inefficiency, when the market's likely to go higher. We're approaching the 450 to 510 macro, and I'm accumulating an early position, anticipating that this volume imbalance into this area, anywhere in that price range between this volume imbalance, which is actually drawn incorrectly there, and then right there is my fill. It went down, and then once it went back into the volume imbalance, you can see my fill is right there. Okay, and then we have a breakaway gap. That's why I shaded it in that little recorded video yellow, because I wanted to see it stay open. Any other time you would see a green or blue, that's bullish. And then I entered here on a retracement back down into this order block. That means this is what? This is a propulsion block. And then right again, it trades back into the propulsion block. If you look at the month 4 content, 2016, I shared that link also on X this morning. But month 4's content of 2016 mentorship, it's on my YouTube playlist. I teach you the propulsion block. Propulsion blocks can be traded to again, as it does here. And I'm entering it as it's trying to go down into it. I'm hitting it there and there, and then exiting out right up there. And then ultimately it rolls back down and comes back for my initial entry, which Phil was coming back for any of you guys that want to hold for longer. All right, so I got a couple more seconds. I can talk a little bit about this. How did I get this exit? Where did that come from? Well, if you take the fib, place it on this price run here. Here's my fib setting, so you guys can screenshot that. And negative 1.25, that's what I'm aiming for, okay? And then it rolls over and comes back down. The quarters is when there's going to be another retracement back, and it'll all be in the book. So I know you're all looking for ways to get a constant setting and what I use what settings for. It's too good for public consumption right now because everybody's trying to make mentorships and write books before mine, and I'm not going to give you your source material. That's not happening. Once I put it in form, written form, then y'all will be going in there plagiarizing it. All right, so we have about 30 seconds or so, and we're going to see what we see here. There's sell side here. We've already disturbed this. We have a little bit of a ways before we get up to those levels up there, but we could certainly make some ground at 15 seconds or so. But I'd like to see them first take this sell side out here, mess this up a little bit. Holding a bias to the bullish side, but loosely, because I'm more inclined to anticipate what it's going to do going into the opening bell at 9:30. All right. And because there's multiple reports coming out, there's always like this staggered initial rally or decline, and it feels like it's done. It's not. You got to give it a couple seconds, and it'll be like another impulse. When it's one report, like medium impact or high impact news driver at 8:30, usually it's the first run that is your Judas swing. But because we have multiple reports at 8:30, give it a chance to take both sides of the marketplace. All I'm doing is annotating. That's where the close near term or short term buy side is, and the sell side is there. And if it goes below here, notice this low here as well. I'm not interested. I don't care about that. I like this here because that's just like a mohawk. And below these lows, we have this imbalance here, and we have all of these candles here that are indecisive. So whenever it's like this is actually a good point to talk about something you've never learned about. We have a volume of it. I'm sorry, we have a fair value gap, and then we have two indecisive candles. Notice that? So you would think that this would be how you would frame that imbalance. So if we go below the lows here, where could it trade to? You might look at something like that. And by in and of itself, it's not technically wrong, but it's not as accurate as it needs to be. So the way you would do that is your lowest open and close, which is the same on this candlestick. It's also the low of the volume imbalance here. See that? You got to cover over top of this and this entirely and take it all the way down here like that. that would be your inefficiency. So if it goes below here, that's how I would use it. And then you can use consequent encroachment of that. And the reason why I told you that is because if there's any inefficiencies like volume imbalances or indecisive candles where the bodies are just the open and close the same price, you got to use the lowest one. And it's better for you to do that because there's so many reasons for it to drop down into these volume imbalances in and of itself, and it would just overshoot the typical standard fair value gap that you would have assumed that would be likely to be used. I like how he left that here too. See that? Now, let's play devil's advocate for a moment, okay? Let's assume for a moment that between now and 9 o'clock, before I escape, okay? Let's say we don't make a significant higher high here. Now, it can come up and just poke that and come back down into the range, chop around a little bit, and then drop down here. And then if it does that, then I would expect 9:30 to 10 o'clock to give some kind of movement higher, displace higher, and then start looking for discount arrays like bullish order blocks, fair value gaps to support price, but not trade completely closing the low of it. Look for short-term lows to be swept and then rally higher. That would be what I would expect if it does that very thing, trading down here. But if we keep this high and we just bang around in here and don't do this drop down here yet, I would look for the Judas swing at 9:30 into 9:45-ish, something like that. Drop down into that and then send price higher, taking out this high and then accelerating and working towards that objective up there. So 20,659, Tuesday's high. I feel like it's warranted. And it keeps you from, and it keeps me specifically from trying to pick the tops in the market, which is really important. If you do all your work about trying to avoid the biggest mistakes, and it's always going to be the case by trying to pick tops and bottoms, it's easy to pick the lows or the bottoms in bull markets. It's real easy to do that. But it's really difficult to try to pick tops in a bull market. And when you're in a market that's like we have, where it's an election year, there's a whole lot of corruption and a lot of things going on with, I didn't mean to say corruption, I meant, or did I? Manipulation in the marketplace as a result of the election year. I'm watching this volume imbalance in here. Now, if you didn't have this big run here, take that out of that equation, what would you see? Relative equal highs, right? So this first pass up here, I would completely ignore that. Even though that's where near-term buy side is resting, I'm watching these two relative equal highs. I'm ignoring this for the sake of the liquidity on these two highs. Obviously, if it goes above there, it could revisit this high. That's not. I'm not making a case against that. I'm just saying that my eye is jumping to the fact that these two highs are basically identical. So what could happen is, say they're going to hold the market and keep it from going higher until we get into the opening range or later in the morning session, or maybe even in the afternoon. If it goes above these relative equal highs, it can go up to consequent encroachment of the range between these relative equal highs to that high, so about halfway there, and leave that high intact, and then roll down, take out these relative equal lows, take out these relative equal lows, trade into the inefficiency, and then how it would trade down into that would be indicative of what I would expect to see happening in the 9 o'clock opening bell, assuming that it doesn't break lower and just keep falling out, falling off the cliff, if you will. So these high impact news drivers didn't do very much. And you can see the market hasn't had a lot of range delivered. It's kind of reserved, actually. Nothing in here that I would want to be buying. So if it does take off, it would be one of those instances where, okay, it left without me. It's fine. Just like you saw yesterday with the first presented fair value gap, it didn't give us an entry to get short, even though that would have been the play. Sell side was the objective. And because it didn't offer an entry, that's fine. We're just going to use it as a target later on. And I did not forget to do the video with my son last night. I just didn't have the opportunity to get to it. So I'll have to find a way to get to that this afternoon or evening. So normally I would like to have something on in a position ahead of the 9:30 opening bell on a high impact or medium impact news driver day. But I have nothing in here that I would have entered on. So it's kind of like to sit and be still. That's the consequent encroachment level I was telling you, between the relative equal highs to that high. I'm watching that. You can already see they're working that level. I know. Steve Nielsen probably has that in his book somewhere, right? He doesn't. Spoiler alert. I would like for it to stay below this high. Admittedly, that's what I would prefer, and I'd like to see it come back down and disrupt this, or disrupt that, and make an attempt to get in here. That would be ideal, because that would be something that would set the stage for me to really be bullish this morning. But I wouldn't be interested in chasing it in here. And if it was a rally, it's okay. It can run without me, and it's okay. I'll catch the next bus stop. I was hoping to do a little bit more, get up and go this morning at the 8:30 bell. Just didn't give it. But that's good. I mean, we should have a reasonable morning session. It should deliver nice. Price action should be nice. Let's put it that way. Because it didn't give it to us at the 8:30 news driver. It's still kind of like trying to figure out what it wants to do. And because of how price is being delivered, see how spotty it is? We got a lot of wicks in here. We have volume imbalances. And it's not making a higher high. It hasn't made a lower low. It's just maintaining the initial range that was created at 8:30. So this low didn't get taken. This high hasn't been broken since it's been posted. So we're kind of like held in a holding pattern. Which means the hands in there, basically. The algorithm's not doing anything here. It's just they're in there stirring the pot. And whenever you notice those types of things, sit still. Don't do anything, because you're competing against an individual that literally has the control to take both sides of the marketplace and still go nowhere. But it'll look like you're in there taking a very valid long or a very valid short, and then it just evaporates. Once you get in there, you turn over the controls and relinquish your power of stillness by entering the marketplace. And now you have no control over the outcome, and you're at the mercy of where the market's going to go. And when it's like this right now, there is manual intervention, because there's no cleanness. There's no cleanness to the marketplace. It's being held in a range, and because of that, you sit still. Don't touch it. Observe, tape read it. This is what you're doing before you learn even to trade with a demo account, before you're pushing the buttons with a paper trading account. You're in here studying what you're feeling, how you are perceiving price action. And then you're also looking for the things I'm teaching you in this mentorship here this year, where you're looking for signatures to support or negate the idea that the algorithm is running on script, or is it being screwed up by manual intervention? That means the actual market maker is in there doing it manually. They're repricing, sending it to different price levels, but they're still going to follow like an MO, okay? And that's the benefit of learning from me, having that information that you can't get in books and nobody else is going to teach it to you because they don't know it. Perfect example. I mean, you probably were looking at that wick when I was telling you disregard it, even though we have to define that for near term minor buy side, because that's the high at 8:30. I took your eyes to that high and that high and said, ignore this for a moment. These are your relative equal highs. So I would like to see it trade up above that and use consequent encroachment of the portion between these relative equal highs to that high. And look what it did. You see that? That's probably time travel. You know, there's no other explanation for it. I had to be from the future to see that. You can see the bodies. Are they respecting that level? The wicks are being tossed above it. Remember that analogy I used yesterday, like horseshoes? You're tossing orders in these general areas, but the bodies are saying, yeah, I don't know about that. So are they trading to that consequent encroachment of the relative equal highs to here? The wicks are, but the candlestick bodies are stopping. You see that? So I said I would like to see it do this very thing here, trade back down into and disrupt the lows here and the lows here and see if we can get down into that imbalance here. That's what I wanted to see. And I would not be interested in being long. So again, for the asshats that love to watch my stream and then go in other people's channels and comment, yeah, ICT was long. He was looking for longs. No, no. You got to take this stuff with context. Sprinkle it with common sense too. Most of these assets don't have that. So we have this volume imbalance too. I want to see it dig down into that. Just like that. Now it should accelerate and run below these lows here. And if it does, if it accelerates below these lows, it'd be reasonable for it to try to make an attempt to clean up all this area here and then maybe deliver to this inefficiency I have shaded in blue. I would not be interested in being long yet. It's still working out the intervention, let's call it that. So on your charts, what you want to do is you want to annotate the volume imbalances. Inside that range, which is the 8:30 delivery, when the reports came out, all the volume imbalances, you want to extend them over to the right. And as long as we're inside this range, keep referring back to them. Remember that the volume imbalance is the most flexible PD array I have, meaning that it's normal for it to go through it, back and forth through it. And what will happen is if it's going through it, I'll give you some notes for volume imbalance. If it's going through the volume imbalance, which is the first expectation to have for it, because just because it's there doesn't mean it's going to stop price to the tick. It can, but you have to have context around it. So what I like to see is I want to see them trade through them. So it's going to lay a body down over top of it. So in this volume imbalance here, we've seen a body laid down and they buried a bullish body in that volume imbalance there on that candlestick. And then they laid and buried a body with sell side delivery. It means it's a down close candle. So we have an up close candle. Let me widen it up a little bit. This candlestick is up, going through the range between this candlestick's close and this candlestick's open. That's the volume imbalance there. So it's been offered what? Buy side. And then we see this candlestick here lay over top of that volume imbalance right there. Then it's sell side delivery. So when you see that, it becomes efficiently delivered. And then what I do is I treat that as a balanced price range. But because it's such a small, insignificant amount of price data, I don't hold everything on the basis of it creating this up candle over top of it and down candle over top of it. And now when we were already seeing the consequent encroachment, it already started to snap down lower. It doesn't mean it's going to keep dropping. It doesn't mean it can't go back above it and use it as support and rally. But I'm looking for those types of signatures when I'm watching price. So a lot of times when I'm talking to you, my attention is looking at these volume imbalances or the PD arrays, and I'm waiting to see if the signatures that I'd like to see with them are manifesting. And I can see that and talk at the same time. But the value of the volume imbalance is you want to see how they trade through it. In this case, when it was created between these two candlesticks bodies there, it offered buy side. So what is it lacking? Sell side delivery. That's over here. So now because we have that, this volume imbalance is much more meaningful because it has done that. Because it's offered both the buy side and the sell side delivery. So it's kind of like that paint roller analogy. Remember how I talk about how if you had a paint roller and you apply the paint and you press that roller against the wall, as soon as you start pressing that roller up or down, the first foot or so of paint delivery on the wall is going to be ample. It's going to be significant and sufficient. There won't be any little pockets where the paint didn't distribute well to the wall until you get to a point where you start running out of that paint. And then you'll start seeing little pockets where the fabric of the roller doesn't contain enough paint to distribute it to the wall surface. So what do you have to do? Roll the other direction. Roll right back over top of it and deliver paint in those little pockets. Well, that's exactly what price is doing inside the volume imbalance. It's delivering price up first, and then it delivers it down here. So now we went back above it here. So now this, it would be more helpful to me to see it not allow price to go back down below it. It doesn't mean it can't do it. Remember, this is the most flexible PD array, and you have to have that flexibility. You can't demand the same degree of precision that a fair value gap that's bullish, the consequent encroachment to it or the high of it, that level of precision that would be afforded to you there, it doesn't carry the same weight that you would expect with a volume imbalance. They still can travel through them and come back up and then resume. What would cause that to happen? The time aspect, the macro. So when I'm using my volume imbalances, I many times will side with my buy, like basically what I did in London. I knew I was looking to go long. I'll use the volume imbalances to start positioning. And then once the positioning is afforded to me, when the time aspect kicks in, then I'm really going to be looking for the price to start displacing and spooling in the direction of my target. So I can then use the volume imbalance again as a new entry, or I can use it as a means of managing my stop loss. But there's a little bit of management that's required when using the volume balance. I mean, I've seen a lot of people talk about them on their videos, and I'm never going to go into your channel and troll you. Okay, some people that sell stuff, I've done that before, but they either delete my comment or they ban me, so I can't be seen. But they're teaching it improperly. We're inside the 850 macro now. The liquidity here is minor buy side. Now look at the difference between this volume imbalance that we've been talking about, where we had initial buy side delivery, sell side delivery. That's not liquidity, okay? It just means that the market has been offered on the up and then on the downside between these two candlesticks bodies. So think about that paint analogy, rolling the paint roller up and then rolling the paint roller down inside that blue shaded area. And then we use the consequent encroachment here, and then finally it drove through it. So now this is much more significant as a what? A balanced price range on the basis of a discount array. not a premium array, meaning that if it would have came back down and touched it, we'd treat it like a support level, basically, because it's done the efficient delivery between both, and then we left it. Okay, we left it right there. And then any time back to it, it would act as a discount array to send prices higher or support price. And then say you were long in here or long over here, then you could roll your stop loss right below that volume imbalance because it's done its work in framing out a balanced price range because it's delivered buy side, sell side delivery, and then left it here. That won't make sense to you the first time around, but when you start going through your charts and looking at how price is using these volume imbalances, collect a lot of instances where you see this event happening, and you'll know exactly what I'm talking about. Just seeing one example isn't sufficient enough, I promise you. So what's the difference between this volume imbalance and this volume imbalance? Well, this volume imbalance has no body buried over top of it with either sell side delivery or buy side delivery. We just have a wick there. And then we have this we're here, just a wick. There's no bodies buried in this range at all, zero. So when it left here like that, this is behaving just like what? A breakaway gap. There's no bodies left there. It did traverse both sides of this area here with this passed down. It went down through it and came right back up, all in the same candlestick. That is not the same thing as being delivered like it does here. One candle, and at a later time, being delivered on the downstroke. So we have buy side delivery, sell side delivery. Here we just have one little return back into it. Doesn't lay a body down over top of it at all. It just rips and runs away. So it's two different dynamics there that's occurring with the volume imbalance. And you can see how quickly, when you're listening to people try to teach these things, just because you can see a volume imbalance doesn't mean you know what to do with it. Doesn't mean you know how it's going to be used in price delivery. So that's why I get pissed off when people are certainly because they're monetizing their education with my material that they don't fully understand. It's like, I used to watch Doogie Howser on TV, so I'm gonna be a doctor and do an operation on somebody. It doesn't work the same way. Okay, we should see it rip through that minor buy side here. Let's take a look at where we are in relationship to yesterday's 414 settlement. Right now, price is at 545. Yeah, we have a pretty good gap. So we have a premium gap in the making. So we're way up here. So let's play devil's advocate for a moment, okay? Let's say we trade above here and we don't rip and just take off. With a gap premium opening, like we're implied by looking at where we're at now in relation to where we settled yesterday, we're 200 handles or so. We're very close to it. I forgot. I didn't remember what the settlement price is. So I'm trying to use one screen here. The likelihood of the market wanting to go to 50% of that gap would easily take us into the run below these lows here, into this, and maybe even so much as a run below here. And then if it were to do something like that, retail would be very reluctant and want to be long because it's doing that type of thing at the opening bell in the first 30 minutes or so. And then we could change gears and then start working towards a run on a higher time frame, avoiding the top picking dilemma and gravitate towards here. But it's all dependent on how it runs here because we've cleared the minor buy side. I don't want to see it take off from there. I want to kind of see it stay close to this range and just hug around it. It doesn't need to be in the lower half of it. It just needs to not run up there. And then what would happen is it would set the stage for a small little minor initial Judas swing higher, but not really do anything. Take out a short-term high that's left prior to 9:30's opening bell, and then drop, send us down into a discount, try to trade for half the gaps range between where we open at 9:30 versus 414's settlement price when we use the regular trading hours, when we do this thing here. When we set our charts to that, it tells us where our opening range gap is. That's not likely to go away where we are right now. So in the next 30 minutes, I don't think that gap is going to disappear. So we're going to most likely gap higher opening. And then where we'd have to know what the opening price is at 9:30 to get the halfway point. So consequent encroachment of that gap between 4:14 p.m. Eastern time yesterday in regular trading hours to 9:30 opening bell, opening price in electronic trading hours. Drop your fib on that, and at 50% level, that's the 70% likelihood in the first 30 minutes that it's going to trade there. Well, because that's something I would anticipate, I would be looking for something to clear up all these lows in here, trade down to this inefficiency, and maybe so much as going down below there. But that is, again, if we don't just start running higher from here. If we start ripping higher like this, and if we get anywhere above 600, I would be less likely to believe at 9:30's opening bell for it to drop all the way down to do half of a gap closure or even a full gap closure before trading up to here. So it would be something like, if it gets to like 600 before the opening bell, I think they would just use the Judas swing at the opening bell, take us up there, sweep that, and then do some kind of a run on the opening range gap. So there's a lot of scenarios there, and it's all contingent on what the actual opening price is, because you don't know what that price is. I'm waiting for it just like you are. So at 9:30 opening bell, that opening price tells the story of what I just described. What scenario would I use? I just gave you several of them. But based on what it's doing and what it has done at the time of 9:30 would be the basis of how I would trade the opening range and how I would trade the opening range gap and what I would use for my setup and where my draw on liquidity would be. Because if you listen to what I said, to a neophyte, to someone that's really not trying to learn and not trying to pay attention, it sounds like I gave a scenario. It could go up, and if it goes there, I'll be right. If it goes down below here, I'm right. That's not what I said. That's absolutely not what the fuck I said. I said that I prefer it not to run up there yet. I would like to see it stay close to this range that it created around 8:30. But if I'm wrong, okay, because it's always possible, I'm not infallible. If it keeps running and it takes us above 600 here ahead of 9:30, then I would expect them to use that range between 600 to 660 or so. That would be the Judas swing of the morning. And then they would sell off going towards some kind of a gap closure event, mid gap, 3/4 of the gap closure, something to that effect. But because I don't have the time to be in front of you at 9:30, because I'm already over my time limit now, I'm giving you the scenarios that I would use. And all you have to do is listen to this recording again and see what the market actually does. It may not do any of those things, but because I'm not aware of what the actual price is going to be at 9:30, I have to give you scenarios that I would be running through my mind anyway. These are all the types of things I do when I'm waiting for that 9:30 opening bell, based on what I have in price, where is it likely to go, and how could I build a narrative around what they may do at 9:30 if they want to intervene, if they want to take the algo off script and just get in there and stir up the pot. What would they be running on? Who would they hurt? Why would they want to do that? Okay, but gun to my head, we're going here, and here. That's plain and simple, but that's not a straight line. I'm not trying to convince you that it's just going to go straight up from here. It can, but it would be without me. Okay, so I was expecting a little bit more animation here, and it is what it is. But we watched the two volume imbalances. I gave you some details around the volume imbalance and how it books price and how it becomes a balanced price range. And now you're going to be left to the opening bell all by yourself. Chin up. I'll touch base with you guys later this afternoon. I'm certain of it. I'll tickle your Twitter then. And until I talk to you later, be safe.